Before we dive in, a quick disclaimer: this video is for informational and entertainment purposes only. I'm not a financial advisor, and nothing here should be taken as financial advice. Always do your own research or consult with a professional before making any financial decisions. As we step into 2025, it's time to recalibrate our investment strategies. The economic and political landscape is shifting, and that means new opportunities and risks for investors. New presidential policies, potential tariffs, and easing yet still elevated interest rates are just a few of the dynamics at play. To make sure we're prepared, I'm sharing not just my 2025 investment strategy, but also lessons from 2024 and the tools you can use to refine your own approach. But first, let's look back at 2024. It's nothing short of extraordinary. The S&P 500 surged from 4,742 at the start of the year to over 66,000, a 27% year-to-date gain. Meanwhile, the Nasdaq climbed from 14,765 to over 19,000, a 30% gain. These returns far outpaced the historical average of 9 to 11% annual growth. What fueled this performance? One major driver was the September interest rate cut. The Fed's decision to ease monetary policy spurred capital flows into equities, especially in growth sectors like tech. This was a reminder of how closely tied the stock market is to Federal Reserve policy. However, these gains come with a caveat. Valuations are stretched. The S&P 500's price-to-earnings ratio is near 25, significantly above its historical range of 15-20. Even forecasted PE ratios for the next 12 months suggest we'll stay in this elevated zone. This tells us one thing: while markets have rewarded investors handsomely this year, we need to proceed with caution. So, what was my approach in 2024? My strategy revolved around three core principles: regularly contribute to my portfolio through dollar-cost averaging, invest in individual stocks only when I had a strong hypothesis and conviction, stay patient and avoid reactive trading, letting compounding do the heavy lifting. For the most part, these principles worked. I started the year with 20% of my portfolio in cash, expecting higher rates to weigh on growth stocks. That assumption? Off the mark. Tech rallied regardless. But when the Fed signaled rate cuts mid-year, I deployed that cash into equities, a move that paid off. As we approach 2025, it's clear that staying adaptable will be more important than ever. Let's break down the key factors shaping the market next year, starting with the elephant in the room: the new administration. In January, Donald Trump will be inaugurated. While we don't have all the details of his economic plan yet, we know some of his broad goals: combating inflation, cutting taxes, reducing regulation, and introducing tariffs. Let's unpack each of these and what they mean for investors. First, inflation. Trump has promised to lower it, but how he plans to achieve this remains unclear. Increasing domestic oil and gas production is one strategy he's mentioned, aiming to bring down energy costs. But here's the tricky part: Trump also wants to lower interest rates, and historically that works against reducing inflation. Lower rates make borrowing cheaper, which can fuel demand and push prices higher. So, this will be a policy area to watch closely. Now, let's talk tariffs. Trump has pledged a 25% tariff on all goods from Mexico and Canada, plus a 10% levy on Chinese imports. Here's what that means. Tariffs act as a tax on imported goods, and while they're designed to protect American industries, they often result in higher prices for consumers. For example, if Walmart imports a toy from Canada, it will pay $10 for the toy, plus a $2. To maintain its margins, Walmart might raise the toy's retail price, passing the cost onto you, the consumer. Tariffs could benefit some sectors, like domestic manufacturing and agriculture, but hurt others, like tech companies that rely on imported components. Apple, for instance, sources many of its parts from China. If tariffs make those parts more expensive, Apple's costs, and potentially its stock price, could take a hit. So, how should we respond as investors? The key is diversification. Consider balancing your portfolio with a mix of domestic and international stocks, as well as exposure to multiple sectors. This way, you're not overly reliant on any one part of the market. Let's pivot to asset allocation, a cornerstone of my strategy for 2025. Heading into this year, I plan to keep my focus on ETFs. These offer broad exposure and help mitigate risk. At the same time, I'll be rebalancing my portfolio by trimming some individual stock positions, especially if they've grown disproportionately large. Even if that means realizing capital gains, maintaining balance is worth it. Another shift I'm considering is increasing my allocation to cash. In 2024, I fully deployed my cash reserves after the Fed's rate cuts. For 2025, I want to rebuild that cushion. Why? To stay prepared for potential corrections or opportunities to buy undervalued assets. Let's not forget about crypto though. It's a banner year for cryptocurrencies, with Bitcoin nearing the $100,000 mark. Major altcoins like Ethereum and Solana also saw significant gains. Trump's pro-crypto rhetoric and the potential elimination of capital gains taxes on US issued cryptocurrencies could further fuel this rally. For me, crypto remains a smaller but important part of my portfolio, around 5 to 7%. If you're interested in crypto but hesitant about the logistics, consider ETFs that track Bitcoin or other major coins. But remember, crypto is volatile. Corrections of 50 to 70% aren't uncommon, so only invest what you can afford to lose. Let's circle back to cash. Having dry powder isn't just about preparing for corrections, it's also about peace of mind. Markets are unpredictable, and holding a cash reserve ensures you're not forced to sell assets during downturns. It's like an insurance policy for your portfolio. As we wrap up, let's focus on the long-term mindset that underpins my strategy. No matter what 2025 throws our way, the principles of successful investing remain the same. Stay consistent. Dollar cost averaging is your best friend, especially in volatile markets. Diversify. Spread your investments across sectors, asset classes, and geographies to reduce risk. Think long-term. Short-term market movements can be noisy, but over decades, the market rewards patience and discipline. Morgan Housel said it best in The Psychology of Money. If you can earn average returns for an above-average period of time, you'll end up among the top investors. That's the mindset I'm taking into 2020. So, what's your plan for the year ahead? Are you making changes to your portfolio or sticking with what's worked? Let me know in the comments. I'd love to hear your thoughts. Until next time, stay smart, stay invested, and take care.